Brad, we're excited to have you here today. I really enjoyed your book, and I found the book to be super accurate because it's about 30 years ago that I was involved with starting the Eastern Technology Council, and all the founding board members and the two chairmen were both serial entrepreneurs and super successful entrepreneurs, just like you wrote about in your book. And from that particular group, we started the country's first formally organized investor angel network and a $100 million seed fund that grew to be over $2 billion over the next, I guess, 10 years. So anybody who wants to follow the right script has to read your book if they want to make sure that their region is able to develop a great entrepreneurial community. So welcome, Brad.
Mark, thanks for having me. Appreciate it.
So Brad, before we get started about your book, please tell us briefly how you first became an entrepreneur and an investor.
Sure. I started my first company in 1987. It was a self-funded business. I had a partner, and we built a couple $1 million a year company that made about $500,000 a year profit. So we had a good small business that was growing at a steady clip. We were out of the blue acquired by a public company that was growing very quickly in 1993. That company was bought by GE Capital in 1996. During that time, I became CTO of that company, but I also started investing. So I took almost all the money that I made from the sale of my company, and I invested in 40 startups between 1994 and 1996 as an angel investor. $25,000 to $50,000 at a time, sort of at the beginning of the rise of the commercial internet. I then accidentally ended up becoming a venture capital investor and starting a VC firm with a group from a Japanese company called SoftBank that's in the news again these days. And SoftBank had just started to buy US-based digital media companies. A group of us, including Fred Wilson, myself, Jerry Colonna, and a guy named Rich Levendoff were affiliates of SoftBank. In 1997, a subset of us, three of the SoftBank people and me, started a venture fund that initially was called SoftBank Technology Ventures. It was sponsored by SoftBank, but it was our own firm. We ended up raising 3 funds, about $2 billion across the 3 funds, rode the internet bubble up in a fantastic and glorious way, and then had it crush us on the way down. I also started a couple of companies along the way, including one that went public in 1999. At its peak was worth about $3 billion, and also was crushed in the internet bubble and ended up going bankrupt in 2002. I continued to invest at Mobius and also with my own money. In 2006, I co-founded Techstars with David Brown, David Cohen, and Jared Polis. Jared is now our governor in Colorado. David and David run Techstars on a daily basis. And in 2007, I started a new venture firm called Foundry Group with some of my colleagues from Mobius Venture Capital. Today, we have about $2.5 billion under management, about 80 active portfolio companies and investments in a little bit over 30 other venture funds where we're one of their LPs.
And can you tell us what you invest in now? Because we'll head into the book, but I know a lot of people are interested in what you're looking
at. All of my investing is software, internet, technology type companies, hardware and software. So I've made a number of investments personally, for example, through Foundry, but that I've led in 3D printing. Companies like MakerBot, which was one of the first desktop 3D printing companies that ended up getting bought a number of years ago. 2 market leaders right now, desktop 3D printing, Formlabs and Glowforge. We're investors in marketplaces, for example, Rover, which is rover.com, which is a large dog sitting marketplace. Invested in fintech companies such as Avid Exchange and Dwala. Both have become quite substantial companies on that side. So sort of a wide range of businesses. We tend to break our investing into themes at Foundry Group. So we have categories that we know really, really well. And are comfortable with those, including, we like to invest in categories that are generally not the ones that everybody else is investing in.
Sure, sure.
So, one of the places we've had a lot of success over a long period of time is hardware related or consumer electronics related investing. We were early investors, for example, in Fitbit, which my guess is most of you know, that ended up being extremely successful investment.
And what's the size of investments you're typically doing?
Rob, thanks for showing your Fitbit. I think I saw it. That's good.
Yeah.
Our current fund that we're investing out of is a $750 million fund. We have entry points that range from the seed to kind of Series B type investing. Smallest check we typically write's $1 million or $2 million bucks. Typical check into a company is $3 to $5 million bucks is our first check. And then over a life of a company, we'll be anywhere from $10 to $30 million invested.
And so those companies that you do invest in, are you taking, do they have revenue already?
Some do, some don't. The early stage ones, that are at the seed or Series A often have, little to no revenue. Fitbit, when we invested in it, I think had, a couple $1 million of revenue the first year. We've invested in companies that have zero revenue, but we've also invested in companies that were growing quite quickly. When we invested in Formlabs and that had some substantial base. When we invested in Formlabs, for example, they had about $10 million of revenue the year we invested, and they're over 100 million now. Glowforge, which I described earlier, sort of on the similar pace, but we invested before they had a product. We're now investors in a company called Whoop. That's another company. Oh, I see a Whoop down there, Paul. Good job. Next generation of sort of a tracking device that collects about 100 times more data than a Fitbit or an Apple Watch. So much more focused on recovery and helping you keep track of how you're doing. When we invested in that company, I think they were probably $20 million business already. So it's all over the map. We don't have a specific focal point. The focal point for us is much more those themes where we feel like we really know something about the business, the market, and can be really additive as investors.
Are you still, in your book, you mentioned that at one point you were serving on like 25 different boards and you were in a plane all the time. Are you still serving on a lot of boards of companies?
Well, I'm not on a plane at all right now.
Fortunately, yeah.
I had a big evolution in my own life. That when the time you're referring to is in the internet bubble. There was a point in time where my weeks looked like I moved to Colorado in 1995 with my wife Amy from Boston. We ended up in Colorado. We didn't know anybody. One person, he moved away about 6 months later. So we ended up here because we're looking for a place to live. And I have a very deeply held belief that you choose a place to live and then build your life around it rather than go somewhere because of an opportunity. And I didn't expect to do any business in Colorado, even though we've ended up doing a lot here in Boulder and Denver have become very significant startup communities. But at that time that Mark was referring to, late 90s, my Mondays, I'd get up at 4 a.m. I'd drive to DIA. I'd take a plane to California, to the Bay Area. I'd have my partner meeting all day Monday. I'd stick around maybe for Tuesday and do some meetings. I take a red eye to the East Coast where I was chairman of a public company or co-chair of a public company called Interliant. This is the one that hit $3 billion market cap and then went bankrupt a couple of years later. I'd spend a couple of days there and then I'd fly somewhere else because I had investments all over the country, and I'd eventually straggle home on Friday, make it through the weekend. Amy would patch me back up and I'd send me back out. And I was kind of 3 to 4 weeks a month on the road like that. And totally burnt out. I continued to travel a lot until about 2013, 2014, when I shifted really most of my life to being based in Boulder and a couple of other places that I have houses, and subsequently being and really embracing being a remote worker. So I've been very, very comfortable in this modality for a long time. And I in some ways, I've been sort of waiting for the world to catch up where it was comfortable with the idea of making investments without having to physically be in person, having a lot of business interactions remote. And while I don't, enjoy the circumstance that we find ourselves in terms of the COVID crisis, that dynamic of believing that I needed to drag my body all over the place to be involved in what I was doing was something that I shifted pretty meaningfully 2014, 2015 timeframe.
I had Tim Draper on about 5 weeks ago, and he said that entrepreneurs should expect to take, at that time at least, a 60% haircut in their valuation. How do you look at valuations now?
I think that's nonsense. I think that the valuation dynamics are not universal. It's very company dependent, and it's very dynamic in the moment. So I think that there's a continual problem across venture, by the way, and I write about this some in VC deals. I didn't use this language, it's investment banking language, but VCs endlessly talk their own book, and promote their companies and or set up situations that are advantageous to themselves in terms of market dynamics. The COVID crisis was and is incredibly disruptive across our society. And I describe it as 4 crises that are all interconnected. A health crisis, obviously the disease, which generated an economic crisis, which subsequently generated or generates a mental health crisis, right? And we wouldn't have had an economic crisis without COVID. I mean, at some point we would have, but it was the case where the health crisis really generated the current economic crisis. The mental health crisis comes from us being stuck in our houses 24 hours a day, 7 days a week, plus all of the exogenous pressures we're dealing with, both around health and economy. And, in the United States, obviously, we just have seen a flare up in a very significant way as a result of George Floyd's murder, of racial inequity crisis. These are crises that go on and on through time, right? Racial inequity crisis has been going on for 450 years. Mental health crisis is something in business and entrepreneurship a number of people like myself have talked openly about for the last 5 or 6 years. I grew up I was in college during HIV and AIDS, which was probably the closest health crisis that sort of affected people around me as this one. Very different characteristics, but same kind of fear and intensity. And interestingly, and I'll come back to the comment about valuations. Interestingly, all of these are complex systems, and they're intersections of complex systems. And the book that I wrote that's coming out, there are the 2 books coming out at the same time. One is the second edition of Startup Communities, which was a book I wrote in 2012 and really created the phrase startup community because that phrase didn't exist before the book came out. And then the new book, which is the Startup Community Way, which is a sequel that we built entirely on the idea of complex systems and how complex systems work and the notion that a startup community is a complex system. If you take that idea, and we can dig into complex systems if we want, and apply it to quote valuations and a statement like entrepreneurs should expect a haircut of 60%. Well, that's not really how a complex system works. It's a warning, and it's a good warning. The warning is financings are going to be more difficult in the short term. And whenever there's any sort of economic dislocation, there's no question that financings can be more difficult. But for example, we have a company that recently raised about $500 million. They'd done about 200 million of it before COVID hit. And they closed the remaining 300 million of it after COVID hit. And they actually did the final close recently.
And what was that business?
I can't announce a specific company yet in terms of what it's done, but large company, a couple $100 million in revenue, growing very quickly. But the capital availability is high, right? It's not that there isn't capital available for a business like that. We've had other businesses in our portfolio, that continue to get financings done. We have one that's an early stage business where the valuation around the financing was as they expected. So they didn't, end up with a discount from where they were targeting. And we've had some other companies that have a lot of distress that can't raise any money. right? So it's not even that they could raise money at a 60% discount, but their business is such that in the context of the COVID crisis and the subsequent economic crisis, there's no appetite from investors. So in the notion of a complex system, like the generic statement of your valuations will be this or the financings will be this, I think is nonsense. I think it's much more important to understand your individual business against the backdrop of what's going on.
So you've invested enough companies, you've known enough CEOs throughout your career. Is there a profile that you look for when you're investing? Like what's the winners that you've invested in? When you look back, you say, this is the profile of these folks, and it's pretty consistent.
I'd say it's a couple of things. It's not individual profiles or personalities, and especially in today's world, where I think as a venture capital community, broadly writ, we recognize that we've had a lot of gender inequity in venture and entrepreneurship, and the lens on it emerged around the Me Too crisis, but there's been a continual effort and some focus by some VCs of getting more gender equity in venture and entrepreneurship, certainly in the last 3 or 4 years. We're now sort of paying attention to that same thing and trying to be engaged and be effective around racial equity. And one of the things that you learn very quickly when you start thinking about that is that self-referential networks that have everybody that looks the same, ends up being very exclusive of people that don't look like what the networks look like. The third principle of something I labeled the Boulder thesis from startup communities, I came up with 4 principles. The third—
We're going to talk about that. I have a question about that.
Great. So the third principle specifically was a startup community has to be inclusive of anyone who wants to engage at any level. So if you then apply that to the question you just asked, the idea that you want to look for people that have a certain set of characteristics that are part of the network that you already have actually in some ways works against one as an investor. So our approach at Foundry has been very different. We look at 3 things. Again, we have a filter, which is the themes we invest in. If what you're doing is not in a theme, we just say no. And if you're not in the US or Canada, we just say no. We sort of picked an area that we feel like we're good at. Assume that you fit within one of our themes, what you're working on. We then look for 3 characteristics. Number 1, do we have affinity for your product? We don't have to be daily users of it, but we have to care about it. We have to have affinity for it. The reason for that is having invested in many, many companies over the years that I didn't really have affinity for the product. When everything's going well, doesn't matter. But when things aren't going well, which happens in every business I've ever been involved in, even the incredibly successful ones, if I don't have affinity for the product, it's very, very hard to put the work in as an investor. You sort of end up in this mode where you're not helpful to the entrepreneur because you don't care that much about the product. Again, if it's going well, no big deal. But so that affinity is important. The second is we're looking for founders who are obsessed about what they're working on. And we use the word obsessed instead of passionate very deliberately. It's very easy to fake passion. It's very easy if you're an extrovert to convince people that you're enthusiastic or passionate about something. And by the way, if you're not an extrovert, if you're an introvert, oftentimes you don't appear to be passionate about things that you happen to be obsessed about. And so we look for those founders who are put on planet Earth to work on the thing they are working on. And then the third is that we're looking for founders who want us as their partner as much as we want to be partners with them. So it has to be both directions. It has to be us really wanting to invest, and it has to be them really wanting us as investors. And we've certainly missed some great investment opportunities and companies that did very well because the entrepreneurs kind of didn't view us as additive in a meaningful way to their business. We were just money. And if we were willing to pay the highest price, then we could get into the deal. And that's a strategy within venture, but it's not ours. And we've chosen instead, again, in this context of these 3 things, right? Affinity for the product, entrepreneurs who are put on this planet to do this thing, and a real desire to have a long-term relationship with us. as the primary characteristics that we're looking for.
So let's jump into your book. Why did you write this? I mean, this is a second version of the first version, but why did you even write these books?
Well, so I wrote Startup Communities in 2012 because I was exhausted. And I started writing it probably in 2010. I was exhausted by the idea that the only place you could start a successful company was the Bay Area. And this was a common mantra that had been going on for a while. It came and went through the internet bubble, but then sort of started to reappear. Of course, 2008 to 2010, we had a global financial crisis. And coming out of the global financial crisis, there started to be some discussion and articles written about how innovation and entrepreneurship were the way out. And that was the way that our economy globally would rejuvenate itself. I started Techstars in 2006 with David, and Jared, with the idea of building, we didn't call it a startup community at the time, but building this activity in Boulder around getting 10 companies a year funded and up and running and putting them through a 90-day accelerator back when the idea of an accelerator didn't really exist. It was a brand new concept. And we really just wanted to engage our local community, the people that were entrepreneurs and investors, angel investors and successful entrepreneurs and the service providers in Boulder, which by the way is a 100,000 person town, so a small town, but that had a lot of historical entrepreneurship. And we started doing this. And by 2010, an article came out asserting that entrepreneurship was the path forward. And in that article, they mentioned 4 cities as examples. The Bay Area, which of course isn't a city, it's a bunch of cities, it's a region. New York, Boston, and Boulder. And it was curious to me because Boulder was very different than the others. Boulder literally fits in a couple of buildings in downtown Manhattan, right? We're only 100,000 people. Like we could squeeze in there. It'd be a little tight to get in there. And so I started really thinking about what had gone on in Boulder since I'd moved there in 1995. And I came up with this notion of how to do it with a very simple framework called the Boulder Thesis. And as part of that, I labeled it Startup Community. At that point in 2012, there wasn't really a good phrase for what this thing was. People would call them, innovation hubs or research this. Every now and then you'd hear the phrase entrepreneurial ecosystem, but it was a very inaccessible phrase. It was hard to understand what it meant. And so I labeled this a startup community with the assertion that not only could any city with 100,000 people or more create a vibrant startup community, every city with 100,000 people or more needed a vibrant startup community to have a healthy, long-term local community, local city, because of the need to have continual innovation and entrepreneurship as a piece of, not the only part of, but a piece of the fabric of the city. And so I was motivated to write this book as I was writing a bunch of stuff on my blog at feld.com about this and talking about this and exploring it with Techstars, because at Techstars by this point, we had expanded from Boulder. We had a program in Boston, and then we expanded to Seattle, and then we expanded to New York, and then we expanded to Chicago, and then we did a corporate program with Microsoft, and then we did a corporate program with Nike. And we were starting to have these experiences in lots of different places where the characteristics of the entrepreneurs being the leader of the startup community was so clear in terms of the evolution. And again, 2012, entrepreneurship was still not super trendy yet. It was starting to be emergent. People were talking about it again. You were seeing some funds getting raised. You were seeing a lot more angel investing. You're finally starting to see some new venture funds emerge as seed venture funds around the country. The other part of that, which linked to it, which I talk about in Startup Communities, but I also talk about in the Startup Community Way that was very important, was in the US in 2010, the Obama administration created a thing called Startup America. And it was chaired by Steve Case. And hopefully most people know Steve Case. He's
been to Philadelphia for sure.
He's wonderful. He wrote the foreword to both editions of Startup Communities. And I've learned an enormous amount from working with Steve. He now has a thing called Rise of the Rest, which is the idea that the rest, the non-coastal places, is where the interesting entrepreneurship of the future is in the United States. And he was the chair of Startup America, and it was a public-private partnership. The public side of it, was kind of a bully pulpit, press release, importance of entrepreneurship, some convening. The private side of it, about 50% of the activity was built around the ideas that developed into startup communities. And the idea that every state could be startup this. So we had a startup Colorado, there was a startup Tennessee, there was a startup Texas, there was a startup Florida, keep going. And I think almost by the time the program evolved, there was almost every state had this activity. And the activity was really the beginning of what a role that many people now have is ecosystem development. So people in communities that are entrepreneurs or that work for organizations that help build the startup community. And we really figured out a lot of interesting things in this sort of 2012, 2013 time period around when the book came out.
And now, talk about the four prominent frameworks for regional success, so which I think you're kind of leading into.
Sure. So the Boulder thesis, again, you have to travel back in time to 2012. Because today, some of these ideas may seem very obvious. They're partly obvious because of the success of this concept globally around startup communities. But at the time, all four of them were controversial. They were not obvious. And in some cases, they really went against the grain of how things were set up in different cities. The first, and again, I labeled this the Boulder thesis. The first was that the leaders have to be entrepreneurs. If you didn't have a critical mass of entrepreneurs as leaders in your startup community, it wouldn't go anywhere. And you had lots of situations where you had a university, or you had city government, or you had some nonprofits, or you had an investor, or even a large company that was trying to do something, but they tried to control and organize it. And they tried to control and organize it from the top down versus recognize that, like many things, it's organic and it grows using a network-driven model where the connection between people, the connection, not just the number of connections they have, but the quality of the information that goes across those connections is much more meaningful than having yet another organized top-down structure with a president of the startup community and a vice president of education and a vice president of membership. And so this notion of entrepreneurs as the leaders was powerful. We can talk about this a little more because there's a lot of nuances about who does what and how in the context of a startup.
Well, I'm going to ask you about, you talk about in your book about giving examples of leaders, feeders, and instigators.
Great. So let's come to that in a sec. So the second principle is that you have to have a long-term view. And I described this initially as a 20-year view. Today, I view it as a long-term view from today. You always have to be looking 20 years in the future. So many of the things in our world run on short time cycles, days, weeks, months, quarters, annually. Elections sort of run on 4-year time cycle, except for politics runs on a 2 to 4 year time cycle, but they have these election things, that soaks up a bunch of time before and a bunch of time after. University runs on an annual cycle with a 3-month summer vacation. If you're an entrepreneur, you have to think long-term. And if you're building a startup community, you do too. The third principle was this idea that you want to be inclusive of anyone who wants to engage at any level in the startup community. There's no price of admission. You're building this vibrant network of anyone who wants to engage and participate. And so welcoming them in and having a very easy way for people to engage and get involved and play leadership roles is key. The last is the need for regular activities around entrepreneurship. That's actually the practice of entrepreneurship. Examples of these would be things like a Techstars Accelerator or a startup weekend, which at the time in 2012 was an independent organization, now is part of Techstars. The activity of getting people together around company creation for extended periods of time, as distinct from what most cities had, which was Entrepreneur of the Year events, or cocktail parties, or networking events that tended to be very exclusive, or invite only, or limited. These things are fine, but they're not sufficient. It's nice to get an Entrepreneur of the Year award. It's nice to have a party, but that's really not sufficient in terms of being inclusive around getting people involved in entrepreneurship. And when you start to super saturate a community and there's multiple events going on all the time, some magic starts to happen. So those were the four principles in the Boulder thesis. And it was very interesting when I reflect back on it in 2020 and I updated the book for the second edition. You know, I looked hard at that and I thought hard about what had happened. And in the sequel, The Startup Community Way, which is the other book that's coming out, we actually extended those four principles to 12 characteristics or principles of the Startup Community Way. So we added some more specifics, but you can group the specifics into each of those four principles. So really you have these sort of four overarching drivers.
So talk about the leaders, feeders, and instigators and how they all fit into the equation and how can they help make a successful entrepreneurial region?
So I'm going to start with, I'm going to break this into two parts. One is the 2012 part, and then I'm going to describe what I got wrong. And then I'm going to describe the update in both books, in the second edition and the Startup Community Way. In 2012, I created two categories, leaders and feeders. And I said the entrepreneurs are leaders, everyone else is a feeder. And I then went on to describe the different roles and characteristics and dynamics that leaders have and that feeders have and what they do and the interplay between the two. The mistake I made was I did not mean to create a one-up, one-down relationship. Leaders and feeders are both incredibly important in the development of the startup community. One's not more important than the other. They were just different. And I could have called them apples and papayas, right? But I didn't do a good job of testing the words. And so in the update, as well as looking forward, I created a third category, and that third category is instigator. And of the three categories, leaders, feeders, and instigators, two are people and one is an organization. So leaders and instigators are people. Feeders are organizations. The leaders have to be entrepreneurs. The organizations that participate in a startup community or an entrepreneurial ecosystem, which are distinct things, but related, are feeders. The instigators are people who are not entrepreneurs who play leadership roles. They could be employees of entrepreneurial companies. They could be individuals who want to participate in the startup community and leadership roles. They could work for feeders where part of their job is to be a leader in the startup community or an instigator. So I sort of separated these apart, and it's interesting because the dynamic and the interplay between the three is very powerful. And if you can get it working the right way, where the leaders and the instigators are the ones who are actually playing the leadership role, and the organizations are playing a support role and supporting the growth, development, and evolution of the startup community, things really start to work and accelerate. The last comment I'd make on this, which is important to recognize, is that there's a lot of movement in and out of these roles. So if you're an entrepreneur who's playing a leadership role in your startup community, you have to have a long-term view, but you don't always have to play a leadership role in the startup community. You're going to have periods of time where your business consumes you. You're going to have periods of time where you feel like stepping back and participating in the startup community, but not necessarily playing as aggressive a leadership role. You need to be open to that, both as individuals and as a startup community. And this idea of trying to create, again, a hierarchical structure where there's well-defined roles and responsibilities is the opposite of what you're trying to do. What you're trying to do is build a very vibrant network where people are interacting with each other and it's constantly modifying itself based on whatever is happening over time. One of the reasons, one of the critical reasons why the organizations have to be feeders is because organizations, almost by definition, not all, but the vast majority are hierarchical, and they just want to organize things. They want to put things in their boxes the right way, and they want to get leverage and control over things. And instead, they often lose sight of why a startup community exists in the first place. The whole reason a startup community exists is to help entrepreneurs succeed. That's it. And so when you start focusing on helping entrepreneurs succeed, and you allow the entrepreneurs to be the leaders in that dynamic, you're in a very, very different place than when you try to construct something that is static and more organized.
It's clear that you're super passionate about entrepreneurship. You've been a very successful entrepreneur, you're an investor. There are communities where the super successful entrepreneurs aren't willing to step up. They're on to the next thing, or they just don't want to be involved. I mean, in Philadelphia in the late 80s, early 90s, when I was running the Tech Council, you had a couple of guys who were hugely successful like you, driving the whole process as entrepreneurs, and everybody wanted to get involved. In fact, the board that I was ran, there were no service providers in that board. They weren't even allowed to be on that board. So why did you jump in, and how do you get these successful entrepreneurs like yourself to step up and get involved? What's in it for you? Because everybody wants a ROI.
Well, there's a couple of things. And when you look across the world, where there are now startup communities everywhere, right? So it's no longer limited to a few places. Entrepreneurship, I'd like to assert that entrepreneurship has been a democratizing force globally, and the notion and activity around entrepreneurship has also become democratized, where it's much less limited to a certain set of people that have a certain set of resources or a certain set of opportunities, but really the understanding is become democratized. For me personally, I operate under a business philosophy, and I'll talk about it personally, but let me talk about it also sort of generally, because I think the two are helpful. For me personally, I operate under a business philosophy that I wrote a couple of paragraphs about in that first startup community book. And I didn't really think very hard about it when I wrote these couple of paragraphs. I just wrote them in a section called Give Before You Get. And the section Give Before You Get essentially says the way to get a community going, really to get the flywheel going, is to get as many people as possible putting energy into the system without expecting anything in return up front. It's not altruistic. You expect to get something back, but you're not defining a transactional relationship. So you're willing to put energy into the system without knowing what you're going to get back, from whom, when, over what time period, and what consideration. And if you can get people operating that way, which I saw in writ large in Boulder, all of a sudden you have this incredible amount of activity and stuff starts to emerge from it. But again, it's unpredictable. You don't know where the things are going to emerge. Techstars adopted that philosophy. Some of it was my own way I had been behaving for a long time. It was part of the dynamics around mentorship and how at Techstars we approached mentorship. And what came out of it was Techstars decided to hashtag my saying. So somebody at Techstars decided Give Before You Get is too long for a hashtag. So they changed it to Give First. And that has become the essential philosophy of Techstars, but it's my own underlying business philosophy. And if I sort of state it back again, it's my willingness to put energy into something that I'm interested in, but without defining it transactionally up front. I do expect to get something back. I just don't know when, from whom, in what time period, and what consideration, what magnitude. Now, if you take that more generally, people are motivated for very different reasons in terms of how they put energy into some things. I would assert that a lot of people in the entrepreneurial world recognize today that we're not playing a zero-sum game. It's not a situation where I win and you lose. The ultimate zero-sum game is examples would be sports or politics. There is a winner and there is a loser of each event. But in the development of a startup community in a city or the development of a business, it's rarely a zero-sum game. When businesses get to a certain size, there's a lot of zero-sum game behavior, but I much prefer to play what I now call a positive sum game. Interestingly, in the 2012 book, I called it a non-zero sum game. I had a hard time sort of recasting it as a positive sum game. But many people in their cities do that because of a very key word, and that word is topophilia. And the word topophilia I learned from John Hickenlooper, who was 8 years governor of Colorado, and also was an entrepreneur. He essentially created the microbrewery business. He had one of the very first microbreweries in Denver, in the world, based in Denver. And John, in one of his State of the State speeches, used the word topophilia, which means love of place. So many people love the place they live in, and they want the place they live in to be better. And they want the place they live in to continue to grow and be vibrant. And the entrepreneurs that live in a place, that love the place, that have topophilia for their city, recognize that they can have a lot of impact on the health long-term of their city by putting energy into the growth and development of the startup community. And as a result of that, what you see is a lot of, again, not altruistic behavior, because you get something for it, but it's unknown what you're going to get from upfront. And that's also, by the way, Mark, and it comes back to the thing I said earlier, is there is an ebb and flow. Like the idea of having to be fully engaged in your startup community while you're running your business, which now is in the middle of an M&A transaction, is very difficult. And so the startup community dynamics have to be flexible enough so that ebb and flow works reasonably well.
When entrepreneurs are looking for the right investors and right board members, what should be the profile they should look for? Because you had mentioned, look, I'm not really interested in just an entrepreneur who just needs me to write a check. I want to be involved in a meaningful way. So how could that be besides just showing up at a board meeting and giving even unsolicited advice?
Well, it feels like a setup question, because one of the other books I wrote was a book called Startup Boards. Yeah. I wrote that book in about 2015. And I mostly wrote that book because most private boards suck. And if you talk to an entrepreneur that has a private board of directors, that has a combination of investors and maybe some outside directors on it, some of them have very, very good boards. But most entrepreneurs will say, my board's okay, or my board's a pain in the ass, or I'm disappointed in my board, or I'm disappointed in this board member. Or I have a board with really capable individuals, but the board itself is very dysfunctional. And of course, there are many, many entrepreneur stories of entrepreneurs being fired by their boards or being fired by their investors, and sort of this negative feedback loop that comes from all that. And so what I tried to do in the book Startup Boards is help entrepreneurs understand more clearly both the actual formal responsibilities of a board of directors, which is specific but reasonably limited in a private company, combined with how a board can actually be helpful to a growing company when it's developing. My own experience with boards, and I've been on boards that I would say are great. I've been on boards that have been terrible. And I've been on probably the vast majority of boards are mediocre. And in a lot of ways, the challenge of the board is partly a function of how the founders and how the CEO thinks about the board. As a board member personally, and I get my board seat usually because I'm an investor. I have one decision I want to make about the company. And that one decision is whether or not I support the CEO. If I support her, my job is to help her succeed. I work for her. If I don't support her, my job is to do something about that, which does not mean fire her. It means work hard to get back to a place where I support her. And occasionally, I'll believe that we need to replace a CEO in a company for whatever reason, and I'm willing to do that work. I don't look forward to it, but I'm willing to do it. But that mental model that I have as an investor director is an important one. And I think most CEOs don't get a good handle on what their board members' mental models are. And they don't work with their board the same way they work with their management team to build a functioning team. And this is a really key part of it, because any CEO that hires senior execs is going to do a bunch of work so that that senior exec team functions well as a team. And if it doesn't function well as a team because one person is not pulling their weight or not doing their job or being counterproductive, as a CEO, you'll fire the person, you'll replace them, or you'll do whatever the work is. And really great CEOs work hard at that. It's fascinating to me that those same great CEOs often do not do the same kind of work with their boards and work to have their boards be an effective team that helps them, the CEO, be successful. So as a CEO, my strongest advice is to understand what the goals, motivations, and mental framework of each of your directors are, and probably before you add them to the board. And then do the work as you've built your board of getting your board to be a functioning team the same way you think about it with your management team.
So you talk in your book about how important it is to raise your money locally before you go out and raise it beyond Boulder, Philadelphia, whatever city you're in. Can you talk a little bit about the importance of raising money locally and how that can affect the overall fundraising process?
Yeah, well, I think at the earliest stages, unless you're a multi-time successful entrepreneur and you already have investor relationships that are not local, the highest chance of successful fundraising is going to come from your backyard. People you already know, people that are 2 degrees of separation, organized angel groups, local angel investors, or local early stage VC investors, of which there are many more of than there were even a decade ago. And when I say local, I don't mean your neighborhood, right? If you're Boulder based, it's Boulder and Denver. You know, if you're Colorado based, it's sort of in the Colorado region. You're looking sort of around that. One of the mistakes, I think, again, this is at the early stage. One of the mistakes that early stage entrepreneurs make, especially first-time entrepreneurs, is not understanding where capital is available for the stage of business they're at, and then wasting a lot of their time hunting for capital in places where it's not really available to them. As your business develops, that starts to change. And generally speaking, I break capital into 3 categories. Very early stage, the first $1 million or $2 million bucks, the next 10 to 20 million bucks, mid stage, and then growth, which is, above the 20 million bucks. So the next 30, 40, 50 year raise. Interestingly, the first and the third have unique characteristics. The first generally is from either your network, 2 degrees of your network, a network you work hard to become a part of. An accelerator generates a new network for you. So if you go through an accelerator, all of a sudden you now have access to a bunch of new potential investors that network opens up for you. And that's, again, where that local focus is powerful. The later stage stuff, money travels. So that money will travel regardless of where you're located, because it's just looking for growing opportunities. The company that I mentioned to you before that just raised a $500 million round, I don't think any of that money came from the city they're in. It came from all over the world. That middle zone, the $10 to $20 million fundraise, is the hard one. The really hard one. If you're making good progress as a business, investors will come to you. And especially if you're growing quickly. So we have a company in Boulder that growing very quickly that we're an early investor in, is in the midst of closing a financing, got a couple of term sheets at prices that were very attractive. So again, back to the 60% discount, I would say that they didn't get discount on their business. Now their business is growing extremely fast. And I think all the term sheets they got were from investors who were not based in Colorado, and they'd only raised a couple of million dollars already. So that middle stage, that can happen if things are going great. But if they're not, if they're going slower, or you're making some progress but not incredible progress, that zone is a really, really hard zone. And in that zone, having investors who are local in a lot of ways help, because then you can leverage their networks. Now, by the way, there's plenty of national seed stage investors. And so my comment here is not exclusionary of that. It's not suggesting that if you're early stage, you shouldn't look nationally. It's that you should be targeted with who you're looking for. You should understand what firms and how firms like True Ventures choose who to invest in, or firms like First Round Capital choose who to invest in, or firms like Uncorp choose how to invest in, because they have different characteristics when they're looking in different parts of the geography based on their own networks. And so it's important to understand that as an entrepreneur versus just think, oh, VC's money is money, I need to just go find some.
Two of my ventures, I've raised money from corporate. I had an insurance venture and I had one in the financial services field. What do you think about corporate venture capital? And do you have you had positive experiences with it? Should entrepreneurs focus on? My particular case, they absolutely had to be the investor because of the kind of business I was in. What's your experience with that?
So I would say generally positive, but depends on the corporate venture capital firm. The CVC is what they're now sort of commonly abbreviated to. And I have in the fourth edition of Venture Deals, which is yet another book. Again, thanks, Mark, for the setup on my endless books. I have a chapter on CVCs, and it's evolved a lot. In the 90s, when I was investing, especially in the late 90s, sort of every corporation started creating a venture fund. And there were, a handful that had venture funds that had been around for a while, like Intel Capital, for example, that I think had venture funds going back to the 70s or 80s. But now all of a sudden, everybody creates a venture fund. And sometimes it's balance sheet money, and sometimes it's a combination of balance sheet money and getting some money from outside. When the internet bubble collapsed, 100% of those CVCs that got created after 1997 went away. So the ones who had corporate venture capital programs prior to the rise of the internet bubble stuck around, Intel, for example, but the vast majority of them just went away as fast as they appeared. And they didn't really start emerging again until probably 2013 or 14. And then they started to emerge with increasing veracity. And some of the ones that had been around for a while, and some larger corporations created structures like Google did with Google Ventures, where it's really a separate entity. So there's a belief that there will be long-term persistence of that. But there were many corporations that, again, used balance sheet money and made a lot of investments, did a lot of allocations quickly. But even in the last 3 or 4 months, with the COVID crisis, you've seen a rapid shutdown of some of those programs or a significant pullback of it. So in a lot of ways, it's important to really understand the CVC that you're working with and what their history is. And if they're relatively new entrant, that doesn't mean that they're bad. It just means understand that. If they've been around for a long time and they have a very clear structural approach, that's useful. Even more with CVCs than with VCs, I suggest and encourage entrepreneurs to do off-sheet references. So it's pretty easy in 2020 to find out who VCs and CVCs have invested in. And it's relatively easy to go look for the companies they've invested in, to do diligence on them while they're doing diligence on you. And if you feel like you're in a position where you have choice, right, where you don't have to have that investor as an investor, here are a few questions to ask that are very powerful. The first is to ask them for 3 companies in their portfolio that have failed, and wanting to talk to founders in 3 companies in their portfolios that have failed. Then, to make it nice, say, I'd like to talk to 2 founders or 2 CEOs who you've worked extremely well with. So very positive case. So they don't feel like you're just picking at them for for negative data. But then the third question is the one where you'll really get an interesting response. I'd like to talk to 2 CEOs you've fired. And there will either be silence, there will be, well, we've never fired any CEO, which is usually not true, or they'll quickly come up with two names of people and happily make intros. And if they come up with two names of people and they happily make intros, it means they're comfortable that even if those entrepreneurs say negative things about them, which they may, that they have the confidence that their reputation is such that it'll be sturdy. So as an entrepreneur, asking questions like that in the diligence cycle is powerful. The CVC part of it is even more interesting because it gives you a feeling for how the people in the CVC actually relate to the entrepreneurs.
So we only have a couple more minutes left, and I want to ask two quick questions. One is, I think all the universities, and I've taught at a lot of universities, feel like students want to become entrepreneurs. They feel that they're also economic development drivers. The community expects them to be economic development drivers. The county and the state feel like they're supposed to do economic development. The service providers feel like they're supposed to contribute something, but they also need that ROI. In fact, all those guys need an ROI. So how do those people play a significant role in their communities over, like you say, it's got to be a 10, 20-year look. In Pennsylvania, we have the Ben Franklin Partnership, which was started by Governor Thornburg and is still hugely successful, started back in the 80s. So that has carried through every governor, Republican or Democrat.
So a couple of things, and I spent a lot of time in startup communities talking about this specifically around universities. And I use CU Boulder as the example. And the startup community way, I go more broadly, not just with universities, but with other types of organizations, especially government. And the interesting thing that I asserted in 2012 was that the university should take a new approach to this. And I used what CU did as the approach. And it's kind of an inside-out approach. And it's been amazing to watch it happen. Most universities view themselves separate from the startup community as it's evolving and approach their work. This is historically, I think this has changed quite a bit in the last 6 or 7 years. But historically, they sort of set up entrepreneurial activity. They set up an entrepreneurship center. Maybe they centered in the business school. They had a technology transfer organization where they tried to transfer technology out of the lab. Maybe there were some entrepreneurial classes, some entrepreneurial clubs. But it was very within the campus and within the university. And the inside out model is the opposite, which is that you, as the campus, you kind of do two things. One is you open your doors to the startup community and you become convening space for activities and events. And you try to get the entrepreneurs in the community, not one by one to come lecture in a class, but in big groups to come participate in activities and events around entrepreneurship. The other is that the participants in entrepreneurship in the university, the professors or anybody in administration, the person leading the TTO, a technology transfer office, instead of having everything hosted on campus, starts to participate actively in what's happening in the startup community. So they go to the startup community. Boulder was fascinating because University of Boulder, or University of Colorado Boulder, is literally a 5 to 10 minute walk from downtown Boulder. Yet they could be on separate planets. They could have been on separate planets. And if you were an entrepreneur, you never thought about going on campus unless you were invited to give a lecture. And if you were a student, you never thought about all of the startups that were in downtown Boulder and engaging with them and the startup activities that were happening all the time because you would sort of stay on campus. And what happened was the leaders, people like Phil Weiser, who is now Attorney General in Colorado, but was the Dean of the Law School, Brad Bernthal, who runs a number of programs. The two of them were key leaders in doing this. Now Terry Fies, who runs innovation at CU Boulder. They're really constantly coming out to the community and engaging with things that are happening in the community rather than hoping that the community comes to campus. Last comment on universities that's super important is every university has two categories of entrepreneurial activities. One is what's happening in research labs, mostly driven by professors and grad students. And then the other is undergraduate students who are interested in entrepreneurship and creating companies. And the problem is that most universities lose sight of their mission, not universally, but they lose sight of their mission the way a lot of startup communities lose sight of their mission, which is the startup community's mission is to help entrepreneurs succeed, and the university's mission is to help the students succeed. If the students want to become entrepreneurs, the university should take advantage of the resource that's adjacent to it in the startup community to help those students become successful entrepreneurs versus just sort of focusing on the research labs and the technology being built on campus. So there's a lot of tactics around that, again, that I talk about in both books. But a lot of it comes back to where we started, which is leadership, right? The three people I named, Terry, Phil, and Brad, in my first book, I called them feeders. In my new book, I call them instigators. And they really were instigators. It was them making it happen. And in some ways being as visible as me or any other entrepreneurial leader in the Boulder startup community. And it wasn't that they were just visible across the university. They were, but that was a place where they spent their time. But then they became leaders and visible across the whole city. It's very powerful for them, and then frankly, very powerful back for the community because or from the university because it reflected really well on it.
Well, I have to say, Brad, this was a really enjoyable session for me. I loved your books, not just book, which gave me a lot of different questions to ask you today. And I think all these communities should be reading your book and thinking about what you said if they really want to grow vibrant communities, which will create wealth and opportunity for the young people so they actually stay in those communities and see success. And for the United States, we absolutely need, because that's, to me, our competitive advantage over the rest of the world is our entrepreneurial community.
Couldn't agree more, Mark. And such a powerful, it's a powerful moment as we're in the midst of this COVID crisis to think about how to re-architect the next wave of innovation in the US and using, the ideas that we built on, and as you said, going back to the 1980s. Like, these are cumulative ideas. They're not like we woke up one day and came up with something new. We're building on what's been working. And like any entrepreneur, like, you run lots of experiments, lots of stuff doesn't work. You stop doing the stuff that doesn't work and you keep doing more of what does work. So, I take a lot of my own inspiration from the kind of stuff that you've been doing over a long period of time. So thank you for that as well.
Well, enjoy the rest of your day. We look forward to when your book comes out, and I look forward to talking to you again soon.
Thanks for doing this. And everybody, I'm very easy to reach. I'll put my email in the chat right now so you have it in case anybody wants to reach out. I just did that. So just mention to me that you heard me here if I can be helpful in any way. And, just a couple of comments at the very end for what it's worth. I mean, I tossed up the pre-order links to the book. I also have created a startup community. And Mark, I'd like to invite you in to be a moderator. I'll send you a link to it.
Awesome.
But I've been waiting for a long time for people to create a virtual startup community that's global, and nobody had. So I just put one up 2 weeks ago using a really good tool called Mighty Networks. It's already got about 2,500 people in it. And it's, again, very bottom up, very organic. It's going wherever anybody wants it to go. But I invite anybody to be a participant in it if you want. And you know what, before we drop, just so you have it, I'll put that link up as well.
The good thing for you to know, Brad, is that we have people from Chile, Brazil, Canada, Africa, all listening to this program today. And we typically are getting people from all over the United States, but we also get people from around the world. So they're all going to take your message back to their communities.
Fantastic.
enjoy the rest of your day. Thank you, everybody, for participating. Look forward to seeing you in another session of the Best Business Minds. Take care.
Thank you, Brad. Thank you, Mark.